Well, good evening, everybody. Welcome once again to the Guide to Your Verizon 401k Savings Plan. I'm Casey Gibb, Managing Director of Financial Planning. With us this evening are Christina and Bobby Hapanowicz. Christina sits on our Investment Committee and Financial Planning Committees, and Bobby helps lead our Investment Committee. So we've been working with Verizon employees for over the last 20 years. You've probably seen us around quite a bit, and welcome this evening. Christina, you want to take it away?
Yes, thank you, Casey, and thanks again, everybody, for tuning in today. We're really excited to bring this topic to you. Something that we always like to put out there, though, is that Hapanowicz Associates is neither affiliated nor endorsed in any official capacity by Verizon or any company for that matter. And that's actually a good thing, because what that means is that we are always in the position to provide unbiased, conflict-free advice to you and to your family, not just now, but for the entirety of the relationship. We are students of the Verizon benefits. As Casey said, we've been working with Verizon folks and helping individuals retiring from Verizon for over 20 years now, but in no official capacity are we associated with Verizon, and that's a good thing for you. So let's dive into this topic, Guide to Your Verizon 401k. The 401k plan is one of the most widely used and popular tools in terms of saving for retirement. And the nuances from one 401k to another are going to differ between one employer and another. And what we're going to do today is talk about the specific nuances with the Verizon 401k and what that means for you. Something we like to point out, though, is typically a lot of people think that Social Security is going to be one of the main sources of their retirement income. And if you look at this chart on the right of the screen here, this is from Vanguard. We love Vanguard. They always put out great information relating to personal finance and retirement planning. As you can see here, on average, Social Security accounts for maybe 1/3 of individuals' retirement income. And the rest of their retirement income, so around 2/3, is supported by other sources, and probably the biggest source for most people is the 401k. So it really is important to put in the time, put in the effort to plan accordingly with that 401k within your overall retirement plan. And we're going to cover some of these things today and how you can actually do that. So let's jump right into it. Let's talk about contributions. Go ahead, Bobby.
Absolutely. Well, Chris, great points highlighting the importance of the 401k and many folks' retirement income plans. It really is, in most cases, the most important portion of the retirement income plan. And that's why it's so important to take the time to plan for the 401k and how much you're going to contribute to your 401k in advance. So with that in mind, how much can you contribute to your 401k as an employee at Verizon? Well, that differs whether you're an associate or a manager. Associates can save up to 25% of their salary in the 401k, and managers can save up to 50% of their salary within the confines of being under the contribution limits that the IRS puts in place. So they put in place a different contribution limit every year. And this year, 2020, the limit is $19,500. And you can also make a catch-up contribution of $6,500 if you're age 50 or older. So if you're 50 or older, your limit is $26,000. If you're under 50, it's $19,500. You have a couple of different options in how you treat the taxes of your salary deferrals. You can make a before tax or traditional contribution, or you can make an after-tax Roth contribution, or you can make a combination of the both. And there's certain times when there are pros and cons to doing one or the other. And we'll certainly get into that in a little bit more detail later on in this presentation. But with that, Casey, I think you have a chart that highlights why it's so important to start contributing when you can.
Yeah, in terms of your 401k, time makes all the difference. The sooner you start, the better off you'll be. This shows it's a nice chart. It shows the annual savings required to become a millionaire or to have at least $1 million in your 401k by age 65. And you can see the difference of annual savings. Somebody who's age 25 needs to contribute annually about $4,700 a year up until 65. Whereas if you wait until you're 40, you have to contribute almost $15,000 a year. So just a huge benefit of starting early. Mm-hmm. It's that magic of compounding. Christina, I think you have a word about that.
Well, Albert Einstein referred to compound interest as the eighth wonder of the world. And it's just one of my favorite quotes to bring up because it's so true. Compound interest is like magic, especially
Something we can all take advantage of.
I truly, yeah. And this graph just shows that all the more, the power of time when it's on your side and using it to your advantage. So
yeah, that's right. Now, some folks get started and it's never too late to start. There's always a plan for everybody. If you're late in starting, go sit down with your advisor and work out an appropriate plan to meet your retirement goals.
Absolutely.
Yeah.
Absolutely. Okay, so we talked about employee contributions. So the contributions that you make, you're giving up income right now to grow your 401k for the future. There's another aspect of contributions to your 401k, and that's contributions that come from your employer. So in this case, Verizon. And how they work are a little different between Mid-Atlantic Associates and managers. So we're going to talk about Mid-Atlantic Associates first. And the date that you want to keep in mind here is October 28th, 2012. If you're a Mid-Atlantic Associate and you started working for Verizon before that date, then Verizon will match 82 cents for each dollar of pay up to the first 6% of your salary that you contribute in a given year. So for example, if you were to contribute 6% of your salary in 2020, the employer match is going to be 5%. Now, if you started working for Verizon on or after that date of October 28th, 2012, the employer match is going to look a little different. It's going to be on a dollar for dollar basis up to the first 6% of pay you contribute. And the reason for that difference is the folks who started working for Verizon before that date are eligible for the pension benefit. And so for those who are not, they're compensated a little differently in the form of the employer match in their 401k. But no matter what date you started working, if you're a Mid-Atlantic Associate, the maximum that you can contribute to help grow that employer match is 6%. Doesn't mean you should stop contributing at 6%. If you're able to save more, great. But that 6% is the maximum that you can contribute to cause the employer match to continue to grow. A few other considerations for all Mid-Atlantic Associates: that employer match is made in the form of Verizon stock, and that's really important to know. Casey is going to be talking about this a couple slides from now, about the importance behind staying on top of that and having that knowledge. And then also for that employer match, for you to be 100% vested in the money that's matched to your 401k by Verizon, you have to have at least 3 years of service. So it's an incentive for you to, stay with Verizon for the long term. Being vested means that you own that money outright 100%, so that if you were to ever retire or leave Verizon and transfer your 401k, if you're 100% vested, you can take that money with you. Okay, let's talk about managers. Go ahead, Bobby.
Absolutely. Manager employer contributions work very similarly to associates, but with a couple of differences. The first of those being that dollar for dollar matching contribution. You receive a dollar for dollar matching contribution up to the first 6% of pay that you defer to the 401k. Very similar to that group of associates that Christina spoke to that joined Verizon after October 28, 2012. The reason why you get that dollar for dollar match, that more favorable match, is because managers' pensions are frozen at this point, so you do get that more favorable match. Mm-hmm. Another really important difference in the manager employer match is that it is allocated to your account according to your current investment choices for your employee contributions, not automatically invested in Verizon stock. So again, that's really important because it makes it that much easier to ensure that your investments continue to be in line with your long-term goals. So that's really important. And again, very similar to associates, 100% vesting, or in other words, complete ownership of your employer match occurs after 3 years of service with Verizon. So a couple of important points to consider when, in regards to your matching contribution.
Okay.
And moving into contribution types, there are two types of contributions you can make. One would be a pre-tax contribution, which reduces the amount of your taxable income currently, so you'd have a tax savings today. With a Roth contribution, they're made with after-tax funds, but the benefit is it allows earnings to grow tax-free. At retirement, when taking out the money from your 401k or IRA account, you would have tax-free income. So it's beneficial to have a combination of the two. You'll probably in your higher earning years use the pre-tax contribution to get a tax savings. Early on, maybe in your 20s, 30s, up into your 40s, use a Roth. In your mid 40s to 50s, use a combination. But there are strategies. Work with a financial advisor to see what strategy is best for you.
It's very true. So important to work with an advisor when making this decision between a Roth contribution or a traditional or a combination of the two, because there are tax implications with that decision. So do work with your advisor, use those resources available to you, and that'll have an effect on the trajectory of those assets within your 401k. All right, so we talked about getting the contributions into the 401k. That's the first step. The second step is, well, what do we do with the money once it's in the 401k? How do we get it invested? And different 401k plans from one company to another have different options available to you for the investments that would go within your portfolio. And so everyone tuning in today, as an employee of Verizon, you have specific options available to you, and you can find that list in the summary plan description. You can also find it by signing in online through your online access. And that list is going to look a little different between Mid-Atlantic Associates and managers, and we're going to get into that a little more, but there are three main components that we think you should be taking into account, really important to take into account when choosing the investments that will go within your 401k. The first is diversification. So diversification between stocks and bonds and within the stock and bond allocations within your portfolio. So diversification means a couple of different things. Risk tolerance. So someone with a higher risk tolerance can afford typically to have more stocks versus bonds in their portfolio. And someone with a lower risk tolerance typically doesn't like to have as many stocks versus bonds in their portfolio. And then that third component is time to retirement. You know, the longer you have until retirement, the more time you have to recover from market volatility. So the more volatility you can theoretically, you know, withstand in your portfolio, and vice versa for the less time you have until retirement. So these are the three main components that should be used to construct an investment game plan. And again, we do encourage you, work with your advisor, use those resources available to you to make sure that you are making that right choice, because what goes into your 401k directly affects the trajectory of your assets in the long term for your retirement. With that being said, let's get into a little more detail about the investment options available to you. And we're going to start with Mid-Atlantic Associates, and I'll turn it over to Bobby.
Great. Yeah, Mid-Atlantic. So whether you're an associate or a manager, in both 401ks, there are a couple of different investing styles. Let's focus on the associates here. If you want a more hands-off, passive style of investing that requires less decision on your part, you might want to look at those investment strategy portfolios. There are 5 of them, ranging from very conservative, which is 0% stocks, 100% bonds, to very aggressive, which is 100% stocks. And there are a couple of options in between. And again, these are more hands-off investment styles, because all you have to do is choose the portfolio or combination of portfolios that gets you to the right asset allocation for you. And then the professional managers that run these portfolios are making the rest of the decisions, almost all the rest of those decisions for you. So that's, again, really good option for somebody who wants a hands-off approach. For somebody who wants a little bit more customizability, there are 9 asset class investment options and 4 mutual funds that cover a wide array of stocks and bonds. And these are certainly great investment options for you as well, again, if you want that customizability. Christina, would you mind moving to the next slide with the manager? And the manager 401k works pretty similarly, with one main difference being that managers have target date funds as their passive hands-off investment option rather than those investment portfolios. And like those investment portfolios, target date funds, once you invest in one, you are your asset allocation is chosen and run by that professional manager. And this actually, target date funds actually take it a step further, in that when as you get closer and closer to retirement, that professional manager will automatically reduce your allocation to stocks and increase your allocation to bonds, and in essence, make your investments more conservative the closer you get to retirement. So in that sense, it takes one more decision out of your hands as well. So that, again, really good option for a hands-off approach. These 16 asset class investment options are very similar to the ones that are available in the associate 401k. And again, really good option for somebody who wants to be able to customize. And, how do I decide what investments are right for me? Again, just goes into what you're looking for in your experience when investing in your 401k. Some folks will use a combination of both approaches too. Just depends on what you're looking for. There's no right or wrong. They're all great funds. They're all great options. It's just finding that one that's right for you.
Yeah. And, we should disclose, we should say that right now, these two lists between Mid-Atlantic and management, these are based off of what is currently available to Verizon employees. But Casey, isn't it right? Every so often, sometimes even every year, a fund can change, can be replaced or removed, or a new one can be added. Isn't that right?
That's right. With the management that recently had last year, year before, they had a bond fund change. This year, the associates, there was a name change with one of the funds. So yeah, there are changes, and we like to keep our clients, future clients, abreast of what's going on with the 401k investment options.
Absolutely. All right.
So as Bobby mentioned, there's stock funds, one of which is the Verizon Stock Fund, which you're eligible to participate in. Now, a little bit different, the Mid-Atlantic Associates, as Bobby mentioned, the employer match is invested automatically into the Verizon Stock Fund. So especially with those folks, it's easy to accumulate large Verizon stock positions, if you're not monitoring it periodically and readjusting your portfolio. Basically, as investment advisors, we feel that concentrated exposures to company stock does increase investment volatility and the risk of your portfolio. So as a general rule of thumb, we suggest limiting your exposure to one company stock to 10% or less. It's a rule of thumb. Some folks, we've seen it, have everything in Verizon stock, but we try to help them diversify the portfolio for sure.
Yeah. Always a good idea to do that for sure. And the 10% rule, that 10% is a starting point. It's really, based off of what your comfort level is and what you individually prefer. But as certified financial planners, as advisors, we typically caution against anything more than 10% because exactly of what Casey said, protecting you from that unneeded volatility, unnecessary volatility, and more broadly diversifying your portfolio for the long term. Okay, so let's get into actually accessing the funds within your 401k. And we're going to talk about this in two ways. The first is while you're still working at Verizon, and the second is once you're retired. So typically we caution against any sort of early withdrawal from your 401k. 401ks are meant to be a long-term savings tool for your retirement. But every so often life happens, and sometimes folks do need to get money from their 401k. So there's a couple of considerations that we think you should keep in mind. The first is any sort of withdrawal from a 401k that doesn't go directly to another qualified retirement account, such as an IRA, will be taxed as ordinary income. So you will have to pay ordinary income taxes on that amount that was withdrawn. In addition to that, if you are under the age of 59 and a half, you will also be required to pay a 10% penalty on that withdrawal amount. So that's one of the many reasons why we typically caution against an early withdrawal from a 401k. That being said, there are a few exceptions to that penalty, and you can see them here at the bottom of the screen. So the first is if you were to take a loan from your 401k, and it's just that, a loan that you would then pay back. And when you do that, you don't have to pay ordinary income taxes, and you also don't have to pay that 10% IRS penalty. You should keep in mind, though, that any outstanding balance for that loan from your 401k is not participating in any sort of market growth. So it's really important to get that loan paid back as soon as possible. You should not think of your 401k as sort of a revolving door of credit or funds, because if you don't get that loan paid back and you don't get it paid back as quickly as possible, it really could affect the trajectory of your assets in the long term within your 401k. Now, the second exception to the IRS penalty is what we call hardship withdrawals. And that's a certain set of circumstances that if they fall under that category and you do take a withdrawal from your 401k, you do not have to pay that 10% penalty. You still do have to pay the ordinary income taxes on that withdrawal though. So if we were able to help you decide between a loan and a hardship withdrawal, we typically would recommend the loan because again, you don't have to pay the ordinary income taxes, you don't have to pay the penalty, and it's money that you would then put back into your 401k. So it's better for the long-term growth of your assets. Okay, Bobby, I will turn it over to you to talk about accessing 401ks during retirement.
Sure. So upon retirement, there's a couple of core options or choices that you have with those assets in your 401k. One, if you're comfortable with the service you're getting and you're comfortable with your investment options, you can absolutely leave those assets in the 401k. You do have that right to leave them there indefinitely if you want to, and defer distributions to a later date, or you could start taking immediate withdrawals from your 401k as well. Having said that, one thing you should be aware of, associates, if you plan on taking distributions directly from the 401k, you're actually only allowed to take one distribution a year. So if you do go that route, make sure that the amount you're taking out is enough to supplement your retirement income needs for the entire year. Managers have a little bit more flexibility than that, but something to be aware of if you do decide to go with that option. The second option, of course, is to receive the money as a lump sum and roll those assets over into an IRA. Christina highlighted the importance of rolling them over into an IRA so that you don't have to pay all those taxes at one time. So that's an option that we do see a lot of folks taking, just because with an IRA, there's a wider array of investment options. There's greater flexibility in how you can access those assets, and there's better service opportunities as well. Now, as Christina mentioned before, there is that 59.5 rule that the IRS has in place. Whereas if you take withdrawals from your 401k before age 59.5, you do incur a 10% penalty. There's a couple of ways to get around that rule though. The first of those being under that sub-bullet under bullet point 2. If you're over age 55 or older in the year of retirement and you leave those assets in the 401k, you can take distributions directly from the 401k without incurring that 10% penalty. So that's one thing to be aware of. And if you're under age 55, you can still access those assets penalty-free by establishing what's called a 72T payment program from an IRA, in which you take a series of scheduled payments that are somewhat exacting. Both of these last two strategies have a lot of moving parts to them. So we do recommend that if you do want to go that route, if your retirement income plan necessitates you going that route, to consult an advisor that specializes in taking those. We, for example, helped many associates with electing both of those options upon retirement. And if you ever had any questions about that, you could always call our office and we'd be happy to help you with that.
Very good, Bobby. So other considerations would be to review first and foremost your beneficiary designations fairly frequently, especially if there's a change in your family condition situation. Review your account on a quarterly basis. Monitor how you're doing, see how the portfolio in your investment mix is performing, and also making sure your payroll contributions are making their way into your account. Also, you want to adjust any payroll contributions with changes in your pay and cost of living increases. And most importantly, work with a financial advisor. You want to be able to answer the question, are you on track for a worry-free retirement, which we do all the time with our clients.
Mm-hmm. Yeah, it's so true. We cannot stress enough, work with your advisor. No question is too small, no detail is too minute to run it by your advisor. It is our job to know every aspect of a 401k plan and how it works, not just by itself, but within your total retirement plan. And that way we can help you get the most out of your 401k and your retirement benefits so that you can get the most out of your retirement income as well. On top of that, we specifically know the Verizon benefits very well. So please do reach out to us. use us as that resource if you don't already have a relationship with an advisor, or if you just want a second opinion and want to run something by us that's very Verizon specific. We are here to help. We have a lot of information to share. So please do use us as that resource. And with that, we will take some questions. So the Q&A box is either going to be at the top or bottom of your screens. Please do feel free to submit any questions to us. And we do have a few already submitted, so we're going to get started with those. Okay, first question. I am an associate during one of the investment strategy portfolios. What do you think of them? Great question. Casey, do you want to take that?
Yeah, I think Bobby really did answer that question. We at the firm really like these strategies. They're fully diversified portfolios. You have exposure to different asset classes and investment managers. And there are 5 you can choose from. You can just choose one. You can choose a combination. You could have maybe one as your core holding and build a portfolio around it. Mm-hmm. But they're fully diversified with different managers, and they just give you great asset allocation exposure. So we answered the question. We really like them a lot.
Absolutely. Okay, great question. Okay, the next question we have here. I have funds in my former employer 401k. Can I transfer it into my Verizon 401k? Bobby, do you want to take that?
Sure. So the answer to that is yes, you absolutely can. Transfer that into your Verizon 401k. As a matter of fact, that's something that we see a lot of folks do just because it helps with consolidating your retirement assets and helps you keep better track of everything. So we do see a lot of people doing that.
And not every company does allow 401k rollovers into their 401k. I mean, the majority of them out there do these days. Not every company does. Verizon is a company that does allow rollovers into their 401k plan.
One more thing I should add to that as well. If you are comfortable with your previous employer's 401k options and their service, you can certainly, in the vast majority of cases, keep those assets within that 401k as well. That's another option available to you too. But yes, you absolutely can roll that over to your Verizon.
And most people do, right? It's usually a good idea for most people, unless there's really a specific reason to keep it at that company. It typically is the right thing to do to consolidate those plans, and that way you can, manage everything in a more efficient way, wouldn't you say?
Absolutely.
Okay, it looks like we have one more question here, and that is, I plan on retiring early next year when I will be 58. Will I be able to withdraw from funds from my 401k without penalty for income next year? Great question. Casey, do you want to take that?
Yeah, that's exactly what Bobby referred to and was explaining. So in that case, you definitely meet the age 55 requirement. You separate from service at age 55 or older. This case will be 58. So any distributions would not be subject to the normal pre-59.5 10% penalty. So yeah, you're in a good position to retire at age 58, take distributions from the 401k, and not be subject to the 10% penalty.
Right. And isn't it a little different from managers to associates in terms of how often you're able to take those distributions, right? Bobby was talking about that a little bit.
Right. Yes. With the associates, they allow an annual one-time distribution. A lot of our clients, they figure out what they need for the year. They take it out in January and do the same in January. For managers, they have a little bit more flexibility. They can take it out multiple times during the year.
Okay, great.
Yeah.
Okay, I think that's it for questions. If you guys tuning in today have any other questions, think of anything else, please reach out to us. Our emails are at the bottom of the screen here. So is our phone number, 412-261-5966. Another thing that we wanted to mention is stay tuned, because we will very soon be releasing on our site the Retirement Red Zone. And this is going to be a one-stop shop for all things Verizon retirement related. All of previous webinars that we've done, not just on the 401k, but on the pension as well. All the resources that you could ever think of to get your questions answered about retirement benefits, you will be able to find it there on that site. We're really excited to present this to you guys. So stay tuned and spread the word. And stay tuned for more webinars as well. We're going to hopefully be bringing a few more to you throughout the year. And we'll be sending this out as a recording, so please do share it with any of your coworkers who you think might find this useful or might have questions about their 401k through Verizon. And we're happy to help. Again, please use this as a resource. That's a no strings attached offer. And thanks everybody very much for tuning in. We really appreciate it, and we will see you next time. Take care.